asked the role of the CEO. Can you see that theory is not necessarily only in question 4? And this is where you guys with business studies come in, because you know this. I'm saying this again to you. The theory is so random all over the place, you cannot spend your time studying theory. So you cover your bases by going through all the theory in the papers that you have. Just making sure you can answer those questions. And then you go in with the idea that most probably you're going to get 0. Okay? You hear what I'm saying? Because it usually counts 15 marks, 14 marks, 13 marks. And usually it's stuff that you know. If I ask you what's the role of the CEO, first of all, who is the CEO? The Chief Executive Officer. This is the big honcho. Ne? I learned that word last week. He's a honcho, the big honcho. Okay, then you just say, you go think of things that you would want and hope that it's right. Okay? What do you want? You want then you go back to your King Code, your corporate governance. And you say, you want someone who takes responsibility for his choices. You want someone who puts the interest of the company first. 4 marks. Okay? Look here. You must be creative in getting new opportunities. That is as business as you can find. Apart from the factors and financial indicators covered in the previous questions. So in other words, you do not use anything you've answered. So if it's somewhere in the answer, you don't use it again. Identify and explain 2 other points indicating the company is well managed. So now you can literally go and look at anything. Anything. Oh, the solvency is better. Ooh, the current ratio is better. Oh, the asset test is better. Can you see, are you going to get marks there? Definitely, because you can randomly answer anything. Just don't be stupid enough to go and quote the operating expenses again, because you already got marks for that. Okay? Can you see that this question, everyone sitting here can get at least 30 out of 50? No? Okay. Do you feel better about ratios? And even if you go look at, I'm quite sure the ones here is more complicated. But if I look at this one, again, let's look. Profitability, that's the one I handed out. And do they have to cut grass when we teach? Profitability, what do you know? Immediately, this is the on ratios. Okay? And if you go look at the on ratios, what is the on ratios? Oh, I see. There's on sales, on sales, on sales. There's 3. What else do I see? This is 2 companies with 2 years. You see that? Now this is the most complicated way that they can ask. Now let's see if we can do this. So they say, identify and explain which company is more efficient in controlling its operating activities. Quote 2 figures. Now, you don't have to say, let me just see if I can see this guy that he can see. Okay, what I want to say with when they ask you 2 companies, okay, and they give you 2 companies, 2 years. You don't have to quote both of them. Look at what they are saying here. Identify and explain which company. So now, oh, sorry, but the dust is now inside my lenses. So now if I go here and I look, my operating ratios, which one looks better? So expenses, this one is 23, this one is 23.9. So this one is better, Profit on sales, this one is better. Net profit on sales, this one is better. So very clearly, Soweto is better. So you're not going to say, oh, the percentage operating expenses on sales of Soweto is so much and Pretoria. You're not going to do that. You're going to ignore Pretoria and you're just going to quote Soweto. Does that make sense to you? Because by just quoting Soweto, you are showing them this is the company with the better things. No? Does that make sense to you? Yes. You're not going to compare them. You've compared them. Now you answer your finding. And what you're finding, Soweto is better. Let's make sure, let's get our minds at ease. Look at the memo. And now the grade 8s are making a noise. I'm going to clock them. They must not do this. Look there. Can you see? Can you see? Only Soweto. So they say Soweto, 1 tick. You don't even have to say Soweto there. You can say the operating expenses on sales of Soweto is 23%. Okay? Now can you see there they say comparison or implied. So by you choosing Soweto, you are implying he is better. Can you see also that in the memo, the things that's underlined is what they look for. That's the minimum they're looking for to give you a tick. And if you look there, they say the percentage operating expenses on sale is 30%. The percentage operating, can you see it's only Soweto? Okay, you guys with me? Okay, let's look at the next one. Next one they say, so I've got my, and why is it 5 marks? Because we've got 1 mark for identifying Soweto. And then you get 2 marks for the ratios. And you only have to mention 2. Okay, now next one, liquidity. Now when I see liquidity, I know there is 6 ratios. So before I go on reading, let's go see which 6 ratios. Current ratio asset test, debtors collection, creditors payment, stock on hand, stock turnover. Can you see there's only 3? Okay. And don't go and try and find 6. You find the ones that's there from the 6 in your head. And now we go and we look. What do they want to know? Identify and explain which company has better liquidity. Quote, 2 financial indicators. Now, can you see the mark allocation is extremely low? Ne? So it means by identifying you're going to get a mark, and by naming and quoting you're going to get 1 mark, 1 mark. So this is a very low order question. So it's going to be straightforward. So let's look at this. If I look, Soweto 1.2, Pretoria 1.8. Can you see? Immediately. Now, what is stock turnover? Which one is better, the high one or the low one? The high one. Because what is stock turnover? It's the amount of times you sell out, so you replace the stock so many times. But now I have a problem here, ne? I have a problem here because can you see Pretoria went down and Soweto went up. My thing is, if I look at current ratio and asset test, it's clear for me that Pretoria is better. But when I look at this, now it becomes for me a medley of confusion. So I would stick to my guts. I would ignore the stock turnover, and I would just go and I would mention the current and the asset test. That's what I would do.
Why?
My my mom. Okay, so now I'm on record that I'm totally confused because it doesn't make sense. So if I read the memo correctly, if I read this memo correctly, you can name any one of the two. Oh, I'm so glad that you've listened to some things, and it doesn't count a lot. So, but this memo, listen what this memo says. Both of them are right. They are basically testing that you know what is liquidity ratios. So just by naming the ratio, so you don't have to compare them. Again, you just say Pretoria Limited and then you quote Pretoria. Or you say Soweto and then you quote Soweto. 3 marks. Yes? You want, because current ratio, so the thing is, you have most inventory, receivables, cash. Ne? And with asset test, it's receivables and cash. So the difference between the ratios is the inventory. So the thing with the current ratio, it's like you want a fine balance, ne? That you don't have too much assets, ne? Because you don't want too much cash. Because your cash can earn you money by putting it in an investment, right? So you must get that fine balance of having enough cash flow to cover your short-term debt, but not so much that it's just lying there ready to be misappropriated. You get what I'm saying? So the ideal is you want at least 2:1 and 1:1. That's what you work towards. That's the dream ratio. Please, under no circumstances do you mention that. It's something you keep in your head. So you always look at which one it's closest and that it doesn't go too much higher than that. Okay? Then this one, you always, if you look at the difference here, it means that it's 50-50. Does that make sense? Your inventory, receivables and cash is 50-50. Can you see that? So you always want a good ratio is when your stock isn't more than double your cash. So say for instance the stock is 10 and the cash is 1, then you have a big problem. So what I'm saying is, if I look at this, if I'm looking at this, keep it simple, don't go difficult, because this can become a very deep rabbit hole. Okay? So what you do is, if I look at this one is closer to 2:1. That's why I'm thinking Pretoria is better, because it's closer to 2:1. Okay? That's the one way I can see it. If I look at the asset test, this one is closer to 1:1. Okay? You get what I'm saying? The other thing I can do is I can go, look, what's the difference? Can you see this one is 0.721? Meaning 70 cents of the current assets is fixed in stock. And only 50 cents becomes cash. Does that make sense? So for every R1.20, 70 cents is stock, 50 cents is cash. If I look at this guy, can you see? Now it becomes worse. Ne? Because now R1.10 is in stock and only 70 cents is in cash. So if I look at it this way, Pretoria is better. If I look at it this way, Soweto is better. Yeah, because, and also if you look at the stock turnover increased so much. So can you see he's making provision to mark for the guy who just sees the obvious and also the person who sees deeper than the obvious. Can you see that both, that's why both is right. Ooh. Good for us. Let's go on. Explain one concern you have about the liquidity of the other company. Quote one financial indicator. Now, so if we chose Pretoria, what makes you concerned about Soweto? Can you see this is now high order, right? What would concern me about Soweto is if you look there, they don't have a lot of stock. Their stock is selling out extremely fast. And what's the problem with stock selling out fast? You can run out of stock. Okay. So that's the thing I would say. Let's look. Let's say Soweto is the better one. What is the problem with Pretoria? Their stock is selling slowly. Okay. Or you can say, what is our favorite sentence? Too much stock tied up, too much cash tied up in stock. You guys get it? Let's see. Okay, you guys are looking at the memo. Am I not on track? Aren't you looking at the memo or aren't I on track? Huh? I love you too. Here we go. Let's see. Why am I not on track? Because I think I am totally right. Let's see. They say Soweto asset test current ratio might indicate poor management of working capital cash flow. Difficult to meet short-term debts. Stock turnover might I am totally right. Thank you. Stock turnover rate might indicate stock is not enough for the demand. If it was Pretoria, the stock, can you see? Stock, it's selling out slower. I was so on point. Next one, dividends. Woo! Now I know it can go two ways. It can go DPS, dividends per share, or it can go dividend payout policy. Okay. Now, comment on the difference between the dividend payout policies implemented by the two companies and explain a possible reason for each. So, let's go look. Dividend payout policy. And now I look at dividend payout rate, just like in the previous paper. Can you see they use different terms to test that you know it's the same thing? So, now, if I look at Soweto, what do I see? They are using more than the earnings. Meaning, where do they get that extra 7.4% to pay out dividends? They're using the retained income of last year. So they're actually making the retained income less. So you can say Soweto. So what did we say? What is our format? Our format is we're going to say the percentage is the dividends paid, out of the profit. And the rest is the retained income. So with Pretoria, it's easy. You say, oh, Pretoria, 74.8% is paid out as dividends, and then the rest, you will say 100 less 74.8 is retained. Why are they retaining funds? For future endeavors or whatever. Ne? Soweto, 107.4% is paid out as dividends, which means they are using retained income to pay dividends. Why would they do that? To make the shareholders happy. Maybe they've done something really bad and their image is like crappy and now they want to soothe the people not to sell. Why don't they want the shareholders to sell? Because it's not going to influence the money of the company, because if the shareholder sells, it's the shareholders' money. So why are they scared that shareholders will sell their shares? No royalties, no. What happens? Where do I see if the share is popular? On the market. And what determines that? The supply and demand. So if so many people now suddenly want to sell their shares, what's going to happen to the share price? It's going to drop. It's going to drop. Just think about it. If I have one remote in this whole school, people will pay a lot to have it. But let's say there's 2 remotes in every class. Will people even want to buy one? No, because they've got 2 already. So the same principle is, if the demand is high and the supply is low, the price goes up. Because it's a competition. The guy paying the most is getting it. But what happens if your shareholders are not satisfied? You've got a very bad audit report. And now they want to sell their shares. They want to get out as soon as possible. So they put their shares, and if you want to get rid of something, you're going to take any price. You just don't want to be there when the company falls. Can you see how cheap it's going to get? Okay. Do you understand the concept of that? Okay, so then what companies might do is they would decide, let's give a lot of dividends so that the people will stay to appease them, because that they don't sell their shares. Or it's like a thank you for people for staying with us. It doesn't have to be negative. It can be positive as well. Okay, so if I look at the memo, what does the memo say? Let's see. It's always good to go check the memo, but it's also very important that if you look at the memo, that you understand that the memo is written in a language that very few of us are talking. Yes.
Is the dividends payout rate, okay, the difference between the dividends payout rate and the return of shareholders' equity, that difference is the return income.
Why are you making that combination?
Why, ma'am?
You are saying the dividend payout rate, and you are comparing it to what?
The ROCE.
Why do you want to compare that?
No, ma'am, because I heard you say the 1.74%. Then when you looked at the ROCE, you said.
Okay, let me draw you. I want to show you something. Remember when we did the appropriation T account? Ne? And I have my profit and loss. The profit and loss is my net profit before tax. Ne? Then I have my dividends, my total dividends. Let's first say I've got my tax, and that gives me net profit after tax. And what's left over? Dividends and retained income. But I also have retained income from last year still. Okay, so this is my earnings. So if I calculate, this is too big, why don't you tell me? If I do EPS, I will say net profit after tax over shares. What's that? That's my EPS. Now, what is dividends? It's your dividends over shares. What is left between those two? It's my retained income. So now when I do my dividend payout rate, it says, if I take my net profit before tax, and in this case, 74% is going to dividends and 26% is going to the retained income. Okay, but now with Soweto, of that, we're taking this 107 is going for dividends, meaning there's not going to be a retained income. There's going to be a retained income, but what's going to happen? I'm going to use that retained income. So this one is going to become less than that one now. Does that make sense? Okay. Be careful to mix too many things. Try and keep them pure. Okay. Here we go. So let's look at this. Just by saying the dividend payout, now it's too small. The dividend payout rate of 74.8, already, can you see? That's a tick. Ne? Means we retained 25.2%. Right? This is for future growth. Can you see? Comment, figures, reason. If I look at what's the possible reason? Is to keep the shareholders. Try to keep shareholders satisfied. I would say the reason was this 64. You see that thing, if we were marking in the final exam, that sentence there is actually supposed to be there. That future growth would be marked as a reason, even if you wrote it here, not there. That's what I'm saying. If I look at Soweto, dividend so much, ne? Used retained income to pay dividends. Okay, it exceeds the EPS. Ne? Keeps shareholders happy. So, I would say this question, we would get at least 4 out of 6. Ne? Because we might not write enough reasons for them. But I think we can get 6 out of 6 if you have just said what I said. And that is like, for Pretoria, the 74%, I'm not going to do the commas now, dividends, 26% retained, future investments, 1, 2, 3. I'm quite sure they mark it like this. Then Soweto, 107 dividends, use retained income to finance the 7%. Ne? 1, 2. Why? Keep shareholders happy. 6 marks. Don't have to talk this way. This is how an auditor talks. We are not auditors, we're grade 12. But a memo has to have the shine of professionalism. Okay, but when we are physically going and marking, that people are literally looking, do you have the concept right? Okay. Next one. Ooh, this is fun. Next one. Gearing risk financing. And then we all smile because we see that we're going to get at least 6 marks in the pocket. Okay? Can I take this off? Or can I... oh no, I can't tear it. I'll give it to you afterwards. Okay, now, if I see gearing risk, I know debt equity, ROTCE. This is the only place we use those 2 ratios. So now they say, ooh, genade, I am swinging around like Tarzan. Explain the specific decisions taken by the directors of each company that have affected gearing and risk. Now, what did I tell you about gearing and risk? Here we're going to do the debt equity. Ne? Quote rand amounts. Okay. Why rand amounts? So they want us to go look what influenced debt equity. What influences it? It's most loan to she. What is loan? It's my loan. Did they make a loan? Did they pay back a loan? She. What is she? Shareholders' equity is capital and retained income. Did they issue shares? Did they not issue shares? Did they buy back shares? Let's go look. So, if I look at this, where's the rand activities? Ah, here at number C. Can you see Pretoria issued shares? Will that have a positive or a negative effect on the risk? It will be positive because now they got more own money, less borrowed money. Okay? Can you see they paid back their loan? Now, let's prove. If you think about it, it's debt equity. If your equity increases and your debt decreases, what's going to happen to your ratio? It's going to go down. Let's see if I'm right. Let's see. Debt equity. Can you see? They're moving towards low gears. You see? So their risk is getting less. It's a lower risk. Okay? So let's look at Soweto. What happened to Soweto? He repurchased shares. So that's not good for cash flow. And he made a loan. So what's happening now? His equity is going down, his debt is going up. What's going to happen to the debt equity ratio? It's going to increase. Now, so let's make sure that I'm not lying. Debt equity, can you see it went from 0.6 to 1.3. Can you see now it's totally high geared? So who made good decisions? Definitely Pretoria. Who made a really bad decision is Soweto. And you're also going to see that that thing is going to have an influence. If they have shown you last year's figures for liquidity ratios, you would have seen their liquidity is taking a dive. Let's quickly go look. What's the question? Explain the specific decisions that they made and quote amount. You can quote 4 things because you can say they issued shares 9.9 million rand. They repurchased shares. You understand what I'm saying here? And that question is a favorite question with the cash flow as well. When you get to the cash flow, they would say, name 2 decisions that the directors made. And then you go look and you'll say, oh, they issued 300,000 shares. They repurchased 260,000 shares. They made a loan. They bought back land and buildings. Okay. So, I wish I made this thing bigger for me. I'm struggling. I can't see anymore. I'm getting old. So, can you see? Where are we? Whoop. I must look there, then I can see. So, yeah, can you see? 2 marks each. Everybody here can get 4. You guys sharp? Before I go on, do you guys want me to go on with ratios? Or do you want me to concentrate? Because we have so much limited time. Do you want me to stop here or finish this question quickly? Or do you want me to rather answer questions?
Let's finish the question.